investor on earth. Every single time you had money to put into the stock market, you waited and waited until the market hit an all-time high. Then, and only then, you invested. No dips. Just peak after peak after peak. You'd assume this person is doomed, right? The poster child for buy high, sell low. Now imagine another kind of investor. This one waits for a dip. She refuses to invest when markets feel expensive. She tells herself she'll buy after a correction. And finally, there's a third person. Someone who keeps waiting, afraid, never investing a single cent. We already know how that story ends. Inflation quietly destroys their savings year after year. But what about the other two? Is buying at all-time highs really worse than waiting patiently for a dip? Or could waiting actually do more damage over time? That's exactly what we're going to break down today. Using real research and a little bit of math that might finally set you free from the anxiety of asking, when should I invest? Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Now, let's get into
Subscribe me because more money-making tips command high, I will tell you.
Picture two investors. Investor A is waiting for a dip. Wendy. Wendy knows perfect timing is impossible, but she has a rule. She never invests at all-time highs. She waits for a 10% pullback. Investor B is bad timing. Bridget. Bridget invests whenever she has money. She doesn't wait. And to make things worse, she has terrible luck. Every single year, she invests at the absolute peak. Now intuitively, you'd expect Wendy to outperform Bridget by a mile. Wendy avoids expensive markets. Bridget buys at the worst possible times. But that's not what actually happens. And this is where real research changes everything. Before we look at the numbers, let's be clear about one thing. Waiting for a dip sounds disciplined, but it's still a form of market timing. You're making a bet that prices will be lower in the future than they are today. And the market doesn't need to crash for that bet to fail. It only needs to keep going up longer than you expect. That's where most investors get stuck. Not because they were wrong about a crash, but because they underestimated how long bull markets can last. And now, with that in mind, let's look at what the data actually says. Researchers at the Archbridge Family Office analyzed S&P 500 returns going back to 1990. They compared three strategies. First, waiting for a 10% pullback from all-time highs before investing. Second, investing immediately whenever the market hits a new all-time high. Third, investing on random days. Historically, investing at all-time highs produced higher average returns than waiting for a dip. It even outperformed investing on random days. That feels completely backwards. Why would buying at record highs beat patiently waiting for a correction? Because all-time highs don't happen in isolation. They tend to cluster during strong bull markets, periods of earnings growth, economic expansion, heavy investment flows. Healthy markets don't hit one high and collapse. They often hit many highs in a row. So while Wendy sits in cash waiting for the perfect entry, the market keeps moving higher. Sometimes that 10% dip never comes. Other times, it comes much later, after prices are already far above where Wendy could have invested. This is the hidden cost of waiting. It doesn't feel risky. It feels safe. But waiting has a price, opportunity cost. While Wendy waits, she misses gains. She misses compounding. She misses reinvested dividends. And most importantly, she misses time. Now let's talk about Bridget. Yes, if Bridget invests right before a major crash, like in 2000 or 2008, that investment takes a hit. The market drops 40 or 50%. Painful, no doubt. But Bridget doesn't invest just once. She invests every year, through crashes, through recoveries, through new bull markets. That means her early investments have decades to recover and grow. A market peak today often looks like a valley 10 or 20 years from now. Think of it like planting a tree. Does it really matter if you plant it on the sunniest day of the year or the cloudiest day? Not really. What matters is that you planted it, and you gave it decades to grow.
कभी नोटिस किया है हम लोग पैसा
Planted it, and you gave it decades to grow. Now let's talk about psychology, because this is where most investors struggle. If you've ever thought the market feels too high right now, you're not alone. This feeling is deeply tied to loss aversion and regret aversion. We feel the pain of losses far more intensely than the pleasure of gains. So when markets are at all-time highs, our brains scream danger. Even though, historically, all-time highs are often followed by more all-time highs. In fact, markets spend a surprisingly large amount of time near record levels. Trying to wait for a better price often means missing the days that matter most. And this is where another powerful piece of research comes in. Looking at decades of S&P 500 data, Hartford funds studied the impact of missing the market's best days. They found that an investor who stayed fully invested dramatically outperformed someone who missed just a handful of top days. Missing only the 10 best days over a 20-year period cut total returns by more than half. Missing the 20 best days reduced returns by over 70%. And here's the key detail. Many of those best days happen during volatile periods, right after crashes and when fear is highest, which means investors who wait for clarity often miss the recovery. This is exactly why so many people never invest, not because they're lazy, but because buying at the wrong time feels worse than slowly losing purchasing power to inflation. So what's the real takeaway from all of this? Should you invest blindly without thinking? Not exactly. But consistency beats perfection. The data strongly suggests that regularly investing a fixed amount, regardless of market conditions, works better than trying to time entries. This approach is known as dollar-cost averaging, and it works because it removes emotion from the equation. I already have several videos on the channel talking about dollar-cost averaging. I really recommend watching them. Now, before you go and dump every dollar into a single S&P 500 index fund based on everything we've just covered, there's a question worth asking. All of this research, the timing comparisons, the best days data, it's all based on the US market. So what if the US is the exception, not the rule? This matters more right now than it has in decades because of something called concentration risk. According to T. Rowe Price, the MSCI All-Country World Index contains roughly 5 times the number of companies as the S&P 500, over 2,500 stocks compared to about 500. When you buy the market through an S&P 500 fund, you're not buying 500 independent bets. Research from Rockefeller Capital Management found that technology stocks alone make up about 41% of the S&P 500, a concentration level not seen since the dot-com bubble. And the data backs this up from another angle too. Guinness Global Investors pointed out that when you compare the market cap-weighted S&P 500 to an equal-weighted version of the same 500 stocks, the gap reveals just how much of the index's recent performance is being carried by a small handful of mega-cap names. If those companies stumble, the index doesn't fall a little. It falls because of them specifically. This doesn't mean the S&P 500 is a bad investment. Historically, it's still delivered excellent returns, and over the long term, it has actually outperformed the MSCI World, largely due to the strength of US companies over the past few decades. But it is clearly less diversified than other indexes. If you found this helpful, let me know in the comments. And if you want...
You got a billionaire first. Subscribe Dark House Finance, I will tell you.